All right, ladies and gentlemen, it is 1 o'clock, so let's go ahead and start with our 1031 Exchange webinar. First of all, I would like to thank all of you for participating in today's class. What we do as an exchange company is we provide continuing education all the time for our clients and the real estate community. And today is just one of those opportunities where we get to share some of our knowledge about the 1031 exchange process with you. We do a bunch of different webinars. We have a basic webinar, we have an advanced webinar, and then we also do today's webinar, which is entitled Problems and Pitfalls. So for those of you who have attended one of our workshops in the past, this is a little bit different. We're not going to go over the basic guidelines or any of the basic information about 1031 exchange. We're going to assume that most of you have some basic understanding of the 1031 exchange process. But we're going to dig deep today into some of the issues that can be really problematic for exchangers, some of the pitfalls, and then how to avoid them. So I am going to be one of your hosts today. My name is Leonard Spoto, and I'm the owner of Asset Exchange Company. I also have my business development manager, Matt Ferenci, on the phone. Matt's going to help out and talk about some issues as well. So a couple quick announcements before we start. Number one, if you have questions during the process, please do type your question into the questions dialog box. So on your webinar control panel, there is a little section called questions. All you need to do is expand or open that section, and then you can type your question in, and it will pop up on my computer screen. Now, Matt and I are going to answer all the questions that we get sent over to us. If for some reason we're not responding to your question right away, it's usually because we're going to touch on that subject a little bit later in the presentation. Now, the second thing I want to mention before we start is that everybody who has registered for this webinar is going to get an email, and when the webinar ends, and in that email is going to be a copy of the presentation material. So all you need to do is click on a link in the email that we send you, and you'll get a copy, or you're going to get directed to download the presentation. So without further ado, let's start going, and we're going to go ahead and begin our presentation. So thanks everybody for joining. I'm going to introduce Matt Ferenci. As I mentioned, he's my business development director, and he's going to talk to you about just kind of what Section 1031 is. So we are going to do a little bit of review, but Matt, go ahead and I'll hand the mic over to you.
Thanks, Leonard. Yeah, so as Leonard mentioned, I'm sure most of you know what a 1031 exchange is, but just to reiterate, Section 1031 of the IRS tax code pertains to investment real estate and tax deferral. Now, what you see below is a excerpt from the tax code that goes over what a 1031 exchange is. I'm not going to read it out to you guys, but essentially the gist is it's a very lawyerly way of saying that when you sell an investment or business property, you can defer paying capital gains on the sale of that property by purchasing or exchanging into another like kind property. And when people do 1031 exchanges, there really aren't a whole lot of very complex steps that are involved, but there are rules that you have to keep in mind and pitfalls that you want to avoid when you do a 1031 exchange. And the first is that you want to make sure that when you do a 1031, you in fact engage an exchange accommodator like ourselves. So a little background about our company. Asset Exchange Company was founded back in 2006 by Leonard Spoto and Adam Skarsgård, and we've done thousands of 1031 exchange transactions each year. Now, as an exchange accommodator, our job isn't to sell real estate or to sell title insurance. We simply facilitate 1031 exchanges, meaning that our job is to hold the funds for you while you do your 1031 exchange because you can't touch the money from the sale. We also make sure we properly document your transaction and ensure that you are in compliance with the tax code. Now, as a company, most 1031 exchange accommodators do the same thing, but where they differ is in their level of quality. So for us, we're a member of the Federation of Exchange Accommodators, and we also carry substantial errors and omissions insurance including a fidelity bond through locked insurance brokers. So if we were to ever make a mistake on a transaction or run away with your money in a way that would cause financial harm, you would be insured pretty significantly, so you wouldn't have to worry about losses on your exchange. Now, we're also a member of the California Board of Accountancy and a member of the State Bar of California because one of our principals, Adam Skarsgård, is in fact a tax attorney. And lastly, and very importantly, we also provide free audit support for our clients. Now, if you were to do a 1031 exchange and your transaction were ever audited, what would likely happen if you went to a different company is they would have you go out and hire a pretty expensive tax attorney to help substantiate the position you took when you did your 1031. Now, the problem there is, A, they're going to be pretty expensive, and B, they more than likely don't know as much about 1031 exchanges as we do, simply because it's something that we handle every single day. Now, although we can't represent you in tax court, what we can do is we can help provide a defense for you that ensures that you hopefully never have to go to tax court by citing private letter rulings and looking up the requisite case law to substantiate the position that you took. Because as we're going to go over in several slides, it is incredibly important that you follow the rules when you do a 1031 exchange so that you are in compliance with the tax code. So let's look into a couple of those. So one problem, too late. So let's go over a little fact pattern here. So let's say we have a client that opens escrow on a $700,000 rental property. The client instructed escrow of the intent to do a 1031 exchange, so they notified the escrow company that that was their goal when selling the property. And the client assumed that escrow set up the 1031 exchange account while the property was in escrow. Now, unfortunately, the property closes on Friday, right? And then the deed's recorded, funds are dispersed to the client, and no exchange account was set up. What's the end result of that? Well, it's that the client owes taxes. And this is a common problem that we have seen people ask us quite regularly. They call us and say, hey, we just closed escrow on a property. Can we set up an exchange account? And the answer to that question is no. Unfortunately, you can. And once you close escrow and no exchange account's been opened up, taxes are owed on the sale of your property. So a very easy problem to rectify is make sure that before you close escrow on your sale, you do the most basic thing, which is open up your exchange account. Because without it, you can't proceed with the 1031. And with that, I'll actually turn the presentation back to Leonard to talk about another pitfall that can take place when you do a 1031. Leonard?
Yeah, thanks, Matt. And this slide's really important because if you're a realtor and you're working with a client who just told you that you're going to do that he or she is going to do an exchange, and even though the responsibility of setting up the exchange account lies with the client, right, the taxpayer, if they've told you, hey, I'm going to do an exchange and something falls through the cracks, usually, in my experience, the clients don't blame themselves. Even though it's their responsibility, what they're going to do is they're going to yell at you, they're going to yell at the escrow company. So do your clients a favor, make sure your clients are happy, put them in touch with us. We'll coordinate with escrow. We'll get everything set up very quickly. We can accommodate rush orders. I have people call me all the time and say, hey, Leonard, I'm closing escrow tomorrow. Can you get the exchange account set up? Absolutely. But you would be surprised, or maybe you wouldn't. We get several calls a week where people say, hey, I closed escrow last week or 2 days ago or last month, and I heard about this 1031 exchange thing, and I want to go ahead and do it. I heard I had 180 days. Nope. Doesn't work like that, ladies and gentlemen. Yes, you do have 180 days to do your exchange, but if you touch the money, it is taxable. So those funds from close of escrow have to come to a neutral third party, a qualified intermediary. So get us involved early in the process. We're happy to consult with your clients, talk to them about the rules, the pricing, everything like that. Just make sure you don't close escrow on an investment sale unless you know that client's going to go ahead and wants to pay the tax bill. All right, so very, very important, and thanks for touching on that very important topic, Matt. Okay, so another very important topic that comes up, you got to follow the rules. And people ask me all the time, how can I bend the rules, or what is this gray area, or can I take a very aggressive position? Well, you can do whatever the heck you want. When you do a 1031 exchange, my company is not the tax police. We are not the IRS. We're going to tell you what the rules are, but ladies and gentlemen, we cannot make you or your clients follow the rules. All right? We're going to lay out in writing in black and white what those rules are, and it is hopefully something that you or your clients will follow. Now, what happens if you don't? And believe me, some clients don't, even though we tell them, hey, what you're doing is very aggressive. If you get audited, you're going to have the exchange disqualified. Well, what happens when an exchange is disqualified? Well, in the best case scenario, if your 1031 exchange is disqualified, you pay taxes. But that is the least likely thing to happen. You will most likely have to pay taxes. You will have to pay interest on those taxes. You will likely pay a penalty or a fine. And in the most egregious of circumstances, you could go to jail for tax fraud. Ladies and gentlemen, this happens all the time. Very important that you know when you are doing an exchange, you are dealing with a tax law. If you are fraudulent, if you're avoiding the tax law, that can be tax evasion, which is a criminal offense. And ladies and gentlemen, people do go to jail for tax fraud or tax evasion related to 1031 exchanges. Don't believe me? Take a look at your computer screen. This is a press release from several years ago now. There's other ones, but this is one I'd just like to talk about because it was May of 2013 that Cheryl Savage, a real estate agent in Salinas, California, got sentenced to 14 months in prison for tax fraud related to her 1031 exchange. Now, what got Cheryl in trouble? Well, let's look at the fact pattern. What Cheryl did was she sold a rental property. She claimed 1031 exchange, so she hired an accommodator. She went out and bought a new replacement property. The property was a single-family residence. She was supposed to rent it out because that's what you're supposed to do when you buy property in a 1031, right? Everybody knows that. Property that you sell and property that you buy in a 1031 have to be investment properties. Now, Cheryl was a real estate agent, and she also put advertising on her website that claimed that she was knowledgeable about the 1031 exchange. So here she was saying on her business website, hey, work with me as a realtor. I am a very knowledgeable about the 1031 exchange process. So when she goes and does her own exchange, she buys a single family residence, and instead of renting it out, she moves into it immediately. She takes it one step further because she then falsifies her tax returns to show rental income on that property that she was not collecting. So, number one, she moved into the property. Number two, she claimed on her taxes that she was renting it out. That is tax fraud, plain and simple. Doesn't get any more complicated. It's just a simple tax fraud scheme that she engaged in. She got audited, and the judge said, hey, you know better. You're a realtor. In fact, you're a realtor who's advertising to the public that you're an expert in 1031 exchange. Why the heck did you not do your exchange properly? She didn't have a good argument. The judge sentenced her to 14 months in jail. Ladies and gentlemen, don't be Cheryl Savage. Do your exchange properly. Okay, a couple things to talk about here. So, number one, don't file fraudulent tax returns. People ask me, not all the time, but every once in a while, I'll get asked by a client, well, Leonard, can't I just move into the property and just make it look like it's a rental? Or can't I just have my son or daughter move into the property and pretend like they pay me rent? Well, you can do whatever you want, but some things that you engage in are fraudulent. And if you get caught doing those fraudulent activities, you have consequences. All right. So you need to know what the potential consequences are so that you can gauge how aggressive you want to be. My company is conservative. We're always going to tell you what to do to stay out of trouble. And if you don't want to be like Cheryl Savage, you want to make sure that when you move into a 1031 exchange property, you do it properly. Now, what does that mean? I thought you just told me I couldn't move into my 1031 exchange property. Well, you can't until it's been seasoned as a rental. So had Cheryl rented the property out for 2 years or more and then booted the tenants out, could she move into it? Absolutely. She could have. So you can definitely move into a 1031 exchange property eventually, but the property first must be seasoned as an investment so that you don't run afoul with the 1031 rules. Okay, so if I get a call to my office, and the client says, well, geez, Leonard, what I really want to do is do an exchange but move into the property, I say, well, can you wait 2 years? Can you rent it out 2 years first and then move into it? Because if you can, you're going to save yourself a lot of heartache and potential jail time if you don't do it properly. All right. So this is a major, major pitfall that people do. In fact, I got an email earlier in the week from a client, and he said, hey, Leonard, we used your company last year for an exchange. I want to move into the property I bought. What do I do? I said, you got to wait another year, buddy. You don't want to move in right away. What I want to see is you rent it out for 2 years, consistently reporting rental income that is verifiable and it's legitimate before you move into the property. All right. Very, very important, ladies and gentlemen. All right. Now, another thing. Matt, am I talking about this one or are you talking about this one? I can't remember what we decided on.
I think this one's you, Leonard.
Okay, perfect. So another thing that we have is people call our offices and they ask about doing transactions with family members. All right. And I'll give you an example. Bob is a client of mine. Bob called me up and he said, well, Leonard, what I'm going to do is I'm going to sell this $500,000 rental property I have, and I want to buy my mom's home. My mom has a home. It's too big for her. It's 4,000 square feet. Grandpa passed away. It's only my mom in this big giant house now. She doesn't want to be here anymore, but it's a great house. So what we're going to do is we're going to use our 1031 exchange dollars to buy mom's property. Can I do that? Now, the answer is complicated because the IRS looks very closely at any transaction that involves a related party in the 1031 world. Okay, so let's just talk about what a related party is first. A related party is someone in your direct lineal family. Okay, so siblings, spouses, ancestors, lineal descendants. So your mom, your dad, your brother, your sister. Now, interestingly enough, your aunt or your cousins are not considered related parties for 1031 exchange purposes. It's just that direct lineal relationship, okay? Now, doesn't stop there, though. A company can be a related party as well if you own more than 50% of the value of the stock, all right? Now, the government takes related party transactions very seriously. In fact, when you report your 1031 exchange on your tax form, they specifically ask you about whether or not the property involved a related party. So they're going to have you fill this out, ladies and gentlemen. If you fill this form out because you did a related party transaction, I will guarantee you one thing. You're going to get audited that year. Let me say that again. If you do a related party transaction, even if it's on the up and up, if you fill in this form, which you're going to be obligated to do if you've done a related party transaction, you are going to get audited. So if you are doing a transaction that involves a related party, you need to make sure you follow the related party rules. What's a related party rule? Well, the government says, hey, you can do an exchange with your mom and you can buy your mom's property as long as your mom does her own exchange. So let me say that again. You can buy the property from your mom in your 1031 exchange as long as your mom is doing her own exchange. So in my example, could my client Bob buy his mother's home? Trick question. The answer is no, because the mother is not allowed to 1031 exchange her primary residence. Now, could my client Bob buy a rental that his mom owned and his mom used as a rental? Absolutely, because then the mom could exchange out of the rental and do her own 1031 exchange. All right? So that's the first part of the rules regarding related party. The second part is you can sell a property to a related party in an exchange only if that person continues to hold the property for 2 years. So Bob wants to sell his rental to his brother and then take the money and do an exchange and buy an apartment building. Is that allowed? Absolutely, provided the brother owns the property, continues to own it for at least 2 years. Now, one of the things that's interesting when we're doing talks about 1031 exchanges and we're looking at revenue rulings and reading the tax code, the 2 years for a holding period pops up a lot. So nowhere in the tax code does it specifically say, hey, you absolutely have to own a property for 2 years for it to be considered exchangeable. But we do see this 2-year threshold in tangential topics like related parties. All right? They want to see 2 years in certain circumstances. So when people ask me, well, geez, what's the minimum I should hold a property? The number 2 pops up a lot. And I always say, hey, own a property for at least 2 years, because we've got some revenue rulings that keep pointing to the number 2 as a holding period. All right, so that's a sidebar. But ladies and gentlemen, can I do a 1031 exchange with my brother, my mother, my sister? Yes, you can, as long as you are following the rules. What happens if you're not following the rules? Well, the government doesn't like that. And remember, on that form I showed you for reporting your 1031 exchange, the government specifically asks you, hey, did you sell or buy from a related party? And if you did, you're going to have to fill out this section and you're going to get audited. If you did an exchange with a related party and you don't fill out this section because you don't want to get audited, then you've just committed tax fraud. You've fraudulently reported your tax form. So, can you do a transaction with a family member? Absolutely, but make sure you are on the up and up, because you can get burned. Now, Vicky's got a good question. I'm going to read it. Vicky, can a person own and live in the property as owner-occupied and sell to a corporation that he or she has ownership and rent it out for 2+ years, and then the corporation would do an exchange? All right. So remember, a related party is a corporation that you own 50% or more of the stock. So this answer, Vicky, hinges on how much of the corporation you own. If you own 10%, yeah, you can sell your property to that corporation. If you own 49%, yes, you can sell the property to the corporation. However, if you own 50, 51, 60, 90, 100% of the corporation, you are not going to be able to do it. So you've got some issues to face. All right. Now, related party rules can get a little complicated. If you are, or your client is considering just doing a transaction with someone they know, a company that they're a part of, pick up the phone, give us a call. We're going to ask them 5 questions and we're going to let them know if it's possible or not. All right? So those are the related party rules. Now, similar to that, when we're looking at who is eligible to do an exchange, what we look at, ladies and gentlemen, is the taxpayer. So the government has a same taxpayer requirement. And they say that the taxpayer who sells the property needs to be the same taxpayer who buys the replacement property in an exchange. Now, this is generally not an issue, because most of the transactions my team works on, there will be a man and a wife, usually a husband and a husband and a spouse, husband and wife, who own a property. They've owned it for a long time as a rental. They sell it, and the husband and wife buy together. Or maybe it's just the husband, maybe just the wife, right? Usually people own real estate and people sell it and they buy it in their same names. So most of the time there's not a problem with this same taxpayer requirement. However, some problems can creep up. Sometimes people do not own real estate in their names, as you guys all know. Sometimes people will form LLCs or partnerships, and the partnership or the corporation will own the property. So if the partnership or corporation is selling, ladies and gentlemen, the partnership or corporation must buy replacement property. The problem with that is sometimes, for example, people will go out and form a corporation, own a property together, and then not want to be partners anymore. So I like Matt a lot. He's a really smart guy, but when I own my apartment building with Matt and we sell it for $2 million, I want to take my money and I don't want to be partners with Matt anymore. The problem is if I own the property underneath an LLC, I am a member of the LLC and so is Matt. That LLC will have its own taxpayer identification number, and the entity that is eligible to do the exchange is not myself and Matt, it is the LLC. The LLC must do the exchange and the LLC must buy replacement property. So I'm stuck with Matt, whether I like it or not, unless I want to pay taxes. That can be problematic. Now, it's not just LLCs, ladies and gentlemen. Trusts can be their own taxpayers. Most of the time, a trust is what's called a disregarded entity. Now, this is important. I'm going to write it on the screen. Most of the time, a trust is a disregarded entity, meaning for tax purposes, it does not exist. All right? So for tax purposes, if a trust is on title, the government says, you know what, it doesn't even exist. What we're looking at is the taxpayer is Bob or Fred or whoever the member of the trust is. However, a trust can turn irrevocable and be assigned its own tax ID number when the trustee dies. So I set up a trust, and the trust says, hey, when I die, my kids, Olivia and Sebastian, I've got 2 kids. When I die, my kids inherit my rental property. So I get hit by a bus, I pass away. The moment I pass away, my trust turns irrevocable, meaning my kids can't change it, right? We don't want Olivia to change the trust and say, no, Sebastian doesn't get anything, right? So my trust is irrevocable. My trust will become its own tax-paying entity and file a tax return. And if my kids continue to own the property through the trust for 2 or 5 or 10 years and then decide to sell it, what happens? Well, the trust is either going to pay taxes or the trust is going to do a 1031 exchange. The problem is Sebastian and Olivia don't want to buy replacement property together. We have a problem. So how do we solve that problem? Well, the day after my funeral, they should go and they should take the property out of the trust and put it in their individual names. All right. What we don't want to do is we don't want to be stuck in this entity, this unique tax-paying entity with a bunch of other members who we don't want to go forward with. All right. The taxpayer who sells needs to be the taxpayer who buys. If you're in an entity like an LLC or a trust with a bunch of other people, well, you might be stuck exchanging with them. So you want to get out of that entity prior to the exchange. Make sense? All right, last thing that can creep up is, and this happens surprisingly a lot, right? Single person goes out and buys a property. So Rebecca goes and buys a property. Rebecca owns it on her own. She meets Bob. Rebecca and Bob get married. Rebecca and Bob go out and buy a beautiful house, raise their family in, and Rebecca's property becomes a rental for the family. Rebecca wants to sell the property and do an exchange. Problem is, they never put Bob's name on title. Rebecca is the taxpayer who is selling the rental. Rebecca should be the taxpayer to buy the replacement property. Okay, this comes up a lot. Bob calls my office and says, "Hey, why'd you tell my wife I can't go on title?" I said, "Well, there's risk." All right. There can be risk in those situations. Now, we can take some steps to mitigate that risk. We can put Bob on title prior to the sale. We can do the exchange in Rebecca's name, and then after a year or two, we can put Bob's name on title. So there are some steps we can take to get Bob on title. But if we are looking to mitigate risk, what I'd like to see is Rebecca sell and Rebecca buy. All right, because that's how the taxpayer has been throughout the history of this ownership. So very important, when you do an exchange, the taxpayer who sells should be the taxpayer who buys. Now, can I sell with my taxpayer? I want to sell my little building here, and this is me. And this building is going to sell for $1 million. Can I do an exchange, but can I bring on a partner? So I want to buy a $2 million building, and I'll own half of it, and Matt will own the other half. Can I do that? Absolutely. So can the taxpayer who's selling bring on a partner? They can, as long as the taxpayer's ownership is enough to satisfy the taxpayer's exchange. So I sold for how much? $1 million. So I need to own how much of this new property? $1 million. So I can bring on a partner, but my ownership needs to satisfy my exchange requirement, which if I sold for $1 million, I need to buy for $1 million. Does that make sense, ladies and gentlemen? I know I'm throwing a lot at you, but you guys are smart and you're paying attention, so hopefully you're absorbing all this stuff. Now, if you have questions, let me know. I see Vicky's got a question here, but it's a real long one. So, Vicky, I'm going to wait till the end to answer that one. But if you've got some questions, you're saying, whoa, slow down, Leonard, you're going too fast. These are concepts that are new to me. Hey, that's fine. Happy to repeat some of this stuff and make sure you guys are absorbing this very important information. Okay, let's go ahead and move on. All right, here's where my man, Mr. Matt, comes in, and he's going to talk you through what's called boot. Boot is an industry-specific term. You're not going to hear about it unless you're shopping for shoes. You're not going to really hear about it in other industries. But in our world, we talk about boot a lot. So I'm going to have Matt explain what boot is and give you some examples. Matt, can you hop back on the line, please?
Yep, absolutely. So basically what boot is in a 1031 exchange is the unused value from the 1031. So I'm sure everybody here knows of the basic rules of the 1031 exchange, but just to reiterate one very important one, which is the second guideline, if you plan to defer 100% of your tax liability, you have to A, purchase property of equal or greater value to what you're selling, and you also have to reinvest all the cash from your sale. Now, there are a couple ways that unused value from the exchange can affect your ability to defer that tax liability. And we're going to go over a couple of fact patterns in the next few slides. So with the first one, let's do a couple numbers. So let's say you have a property that sells for $500,000. And then when it comes to equity, you have $300,000. Well, you replace the value of the property with $500,000, so that's about right. But here's where the problem comes into play. Let's say you had $300,000 in equity, and you decide, you know what, for the replacement property, I'm going to put $100,000 of that down, so 20% of the value down for the replacement. What's the problem with this? Well, the problem is that you didn't reinvest all the cash from your sale. Instead, what you did was you took $100,000 from that $300,000 in equity, and you put that down towards the replacement, and $200,000 was taken out and replaced with debt. Now, the problem is that you have to reinvest all the cash from your sale. If you do not, that boot, which is the unused value, now becomes taxable. So at a tax rate of approximately 33% of your gain, in this particular example, the individual that took out that $200,000 in cash now has a $66,000 tax liability. And this is a pretty common question that people ask because they say, okay, well, I'd like to take cash out for my sale. Well, if I purchase equal or greater value, I can just replace it with debt, right? Unfortunately not. You have to make sure you reinvest all the cash from the sale to satisfy your exchange requirement if you don't plan on paying any taxes. Now, it's not just in the form of cash that this can take place. It can also take place in the form of debt when it comes to boot. Now, let's look at another example. In this particular one, you have a property that sells for $500,000, and then you have also $300,000 in equity from the sale. But you have a replacement purchase of $300,000. So you take all that equity from the sale and you put it towards the replacement, and you decide, you know what, I don't want to have any debt on this property. I'm just going to reinvest all the cash, and that'll work for me. What's the problem? Well, this is something called debt relief. When you have debt relief, you're just like it sounds, relieving of yourself of your debt, and that is an additional value that is gained by the seller when they do a 1031 exchange, and that boot, even though it's not cash from the sale, is in fact taxable. So just like in the former example, where you had $200,000 in cash that was taken out, in this one you have $200,000 in debt that was not replaced, and the result is a taxable event of $66,000. So it's another very common situation where people ask us, okay, well, I don't really want to have any debt on this property, or I can't get a loan for it. Well, what do I do? Well, you either have to contribute additional cash out of pocket, or you will be stuck paying taxes on what you didn't reinvest, in this situation, the debt.
Yeah, and Matt, this is Matt knows very well. I mean, we talk to clients about this all the time. People get angry when we tell them this, right? Because they heard through their realtor, their best friend, or their brother that all they had to do was reinvest their cash, right? So the client says, well, geez, Leonard, why do I pay taxes? It doesn't make sense. All I did was move my cash from one property to another. Well, the rules are the rules, right? The IRS says, hey, if you don't want to pay taxes, you got to reinvest all that cash and purchase property equal or greater. So that means you're going to either, as Matt mentioned, get another loan or contribute additional cash because you need to buy for $500,000. So if you're an escrow officer, if you're a real estate agent, if you're an investor, when you're thinking 1031 exchange, think this: reinvest all the cash, purchase property equal or greater. You sold for $500,000, you need to buy for $500,000. You sold for $2 million, you need to buy for $2 million. Now there's some considerations for closing costs, and we'll get into that. But it's really simple. Just replace the value of what you sold using all of your cash that you've got sitting in the exchange account. You don't do that, not the end of the world. You're going to pay some taxes. So Matt, walk us through a situation where, someone decides, hey, I'll just take a little bit of cash out.
Yeah, and these are actually the more common situations that we receive because, when you do a 1031 exchange, one of the hard parts can be finding replacement properties or suitable replacement properties. And there will be times that clients sell for a higher price than what they purchase. And even sometimes if it's not that much, there is a slight trade down in value. So let's look at this example. You have sale price of $500,000, equity of $300,000, and the replacement purchase is $475,000. And that's pretty common. I mean, you'll have somebody that purchases slightly less in value, and no big deal there. But in this situation, they replace all their cash, they replace most of their debt, and $25,000 was not in fact reinvested. And that ends up being a taxable event. Of course, this one much less than $200,000, but it certainly is there. And, there are a lot of investors that are willing to take a small hit like that off their exchange. But just keep in mind that whatever it is that you trade down in value for will then be taxable on the difference between those two. So here, $500,000 sale price, $475,000 replacement property, $25,000 is taxable. And at a rate of 33%, it's about $8,000. So this may in fact happen to you when you guys do a 1031 exchange, and not the end of the world there, but just know that it could be very possible that this is a situation that arises in your case. And with that, I'll turn it back to Leonard to talk a little bit about the closing costs.
Yeah, and before we jump into closing costs, real quick, so a lot of people ask, well, geez, when do I pay that the tax bill on the boot, right? When does the $8,000 go to the government? Well, it's a little bit tricky because there's two answers. Number one, part of it goes to the state government right away, because when we have an exchange with money left over in the exchange account, we don't refund all $8,000 to the client, because the state of California, and I think most of you are in California, the state of California requires a withholding for any California taxes that might be due. So my company is going to take 3.3% of the $8,000 and send it to the California government. Okay, so California Franchise Tax Board is going to get a check for 3.3% of $8,000. Not a big number, but some of your taxes that you owe to California are going to be paid by us. We're going to send that money over. Now, the federal government, you're going to owe taxes on the on the boot, right? And the federal government, you're going to reconcile with them when you do your taxes on the April 15th deadline. All right. So keep that in mind too. Some of the cash that is sitting in your exchange account will automatically be withheld for the state, and then you're going to reconcile on April 15th with the federal government. Now, Matt did a great job of explaining boot, but we were talking kind of real general numbers, right? We were saying, okay, you sell for 500, you need to buy for 500. And I like to talk in general numbers because it's just easier for people to follow along. But in the real world, things get a little trickier, because if you sell for 500, you're going to have to pay commissions and closing costs and recording fees and transfer taxes, 1031 exchange fees, although our fee is not very big. I wish it was bigger. But when you sell for 500, you're going to have, I don't know, $50,000 in closing costs. Well, guess what, ladies and gentlemen? You're going to deduct those from your exchange requirement. Okay, so you're going to have a $450,000 exchange requirement to be met. All right, so in the real world, we're going to deduct all of our non-recurring closing costs, and you're going to have a net sales price of $450,000. And when you do your exchange, you need to buy replacement property for $450,000 or more. All right, so don't forget about those closing costs, but don't include closing costs that are not eligible. Now, what closing costs are not eligible? Well, you cannot deduct anything associated with the loan or any recurring costs. So what are those? Well, mortgage interest, that recurs. Mortgage prepayments, that is a loan-related cost. Any prorated expenses like property taxes, utilities, all right, anything that recurs on a regular basis, HOA fees, property taxes, or anything associated with the loan. Now, usually this isn't really a big deal, okay? These usually aren't that big of a deal, but I worked on a $20 million exchange one time, and the client had a $1 million prepayment penalty for paying off the loan early. So the client says, well, geez, my exchange requirement is $19 million, right? Wrong. Okay. Your exchange requirement is $20 million, because you can't deduct that mortgage prepayment. All right, so if you're a wheeler and a dealer and you're finding yourself doing $20 million deals and you got these big prepayment penalties, keep that fact in mind, because what I don't want you to do is sell for $20 million and then go do your exchange for $19 million and then have $1 million boot issue. Right? That's a $330,000 tax that you have to pay because you didn't buy enough real estate. That's a big pitfall. And we stepped in with our client. We said, no, that's not what you're supposed to do, buddy. And we got them on track so they didn't have that $330,000 tax to pay. Keep that in mind. All right. So we're going to move on to the next issue, the next thing that comes up that we advise clients on. And this comes up all the time. In fact, I think I had talked to clients 3 times about this week. Client says, Leonard, I bought a property for $100. It is now worth $500. So I have $400,000 of gain that is taxable. However, I had to put in $50,000 for new paint, new carpet. I had to fix the sewer. I had to stage the property. I had to fix the deck. What I want to do is when I sell the property for $500, I want to pay myself the $50,000 back. Can I do that? No, you can't. All right? You cannot pay yourself back for the capital improvements you've put into the property with tax-free dollars. Now, you can always take the $50,000 as boot and pay taxes on it, but you cannot take tax-free dollars to pay yourself back for the cost that you incurred to prepare the property for sale. People get mad about this too. I had a guy scream at me, that doesn't make sense. This is robbery, blah, blah, blah. Well, you know what, buddy? It's the rule. I didn't make them, so deal with it. You can't pay yourself back for these items. Now, if you don't want to come out of pocket for fixing up your property, here's what I recommend you do. You go to a lender and you say, hey, I need an equity line of credit against my property. And you do it 6 months prior to listing it. You get the $50,000 from the lender. You use that $50,000 to improve your property. When your property sells for $500,000, the escrow company is going to pay off the debt to the lender of $50,000. You're going to have the remaining cash go to the exchange account. Now, the problem is you still need to replace that debt, but at least you didn't have to come out of pocket. Does that make sense? All right. What I'm going to do is I'm going to jump through some of these questions here because you guys are stacking up on me. I've got a ton of questions. So let's go ahead and start. Vicky's asked all the questions almost. Vicky's got 3 or 4 questions, but why don't we start here? So Tamara says, after the 1031 exchange is completed, are there any limitations on who the property can be rented to? Can it be another family member? Tamara, great question. I think Vicky asked the same one. The answer to that is you have to rent to an adult. I have a 7-year-old and a 4-year-old. I cannot rent my property, my rental property that I buy in an exchange to either of them. I have to rent to an adult. Now, if Sebastian was 18 years old, I can rent it to him. He'd need to pay me real rent, fair market value rent. But yes, I can rent to my son or my daughter or my mother or my brother as long as they are adults, 18 years or older, and paying fair market value rent. I can also rent to a corporation that I own. Even if I own 100% of it, I buy a building, an office building in my 1031 exchange, and I put my exchange company in there and they pay me rent. That's fine. All right. Legitimate business is fine. If it's a fake business, right? If I buy a house and I rent it to myself for my house cleaning business and I live there and sleep there, nope, not going to work. Legitimate business, yes. Legitimate 18-year-old or more, absolutely. Okay, let's go a couple other questions. So Hamid says, sorry, I didn't quite understand exchanging to and from your own corporation. You mean it depends on the percent ownership? Yes, absolutely. So Hamid and I own a property in an LLC. All right. Hamid owns 10% and I own 90%. The LLC now wants to do an exchange and buy an apartment building from Hamid. All right, so this is Hamid's apartment building. Can the LLC exchange into Hamid's apartment building? Absolutely, because Hamid only owns 10% of the LLC. Now, what if Hamid owned 90%? Wouldn't work, right? Would not work. Good question, Hamid. Good question. All right, so Vicky says, Vicky's got a lot of questions here, but let me see. Vicky, I'm going to start at the top. Your first question is a little confusing. Property is currently owned by Mr. A, 100%, and he will do an exchange, but he's not qualified, so he wants to bring in B. Okay, so yes. So this question comes up all the time. So we're going to sell a $1 million property, and we want to buy a new property. The problem is the seller is not qualified to get a loan, so he wants to bring in another partner. So you're going to have John and Sally. John's got bad credit, so he's bringing Sally in to help him get a loan. Is that allowed? Absolutely. But when they buy the new building, John needs to own $1 million worth of value. So John, he's going to own $1 million. And then Sally, she can own any incremental value, right? So Sally can own any value of the real estate over John's $1 million position, right? So if it's a $2 million building, they can own it 50-50. If it's a $1.5 million building, they can own it 2/3, 1/3, right? Your percentage ownership in the property needs to be enough to satisfy your exchange. But you can bring on a partner to help you buy it as long as that partner and you split your percentage so that your exchange requirement is met. All right, Vicky's got another question. Vicky's talking about some rumors now. Vicky says, I have heard rumors, but not sure if it's right or not. If you plan to exchange in a property, but you don't want to dump in all the equity, some people would cash out money prior to the exchange and use the net. Is that going to work? That works. So what you're going to do is you got a property that's worth $1 million, and the property has no debt on it. Well, you need to go buy another property for $1 million, right? You don't want to pay all cash, so what do? Well, here's what Vicky's talking about doing. Prior to selling this property here, the relinquished property, Vicky's going to go out and get a loan against it, and she's going to take out $500,000. All right, so she pulls out some cash in a refinance, an equity refinance, or cash out refinance. So Vicky gets $500,000. That is a non-taxable event. Let me repeat that. A refinance, a cash out refinance is a non-taxable event. Vicky can get $500,000 out. Now the problem is Vicky's got a loan on this property now, and when she buys her new property, she still has to buy for $1 million. She has the $5,000 in equity to use as a down payment, and she's going to need to go out and get another loan so that she's buying enough real estate to satisfy her 1031 exchange requirement. Does that make sense? All right, very, very good question. Hey, Matt, I have someone who wants you specifically to explain the reverse exchange for us here. So can you give me an example? I've got two buildings here, and Matt's going to walk us through. I've got my property number 1, and I've got property number 2. So I've got a client who wants to buy property number 1 first and then sell property number 2 in an exchange. That's called a reverse exchange. Matt, walk us through how that works.
Yeah, absolutely. So with a reverse exchange, essentially what's happening is on like a regular exchange where you close escrow on the sale of your relinquished property and you purchase the replacement property, you're now purchasing the replacement property first, and then once that purchase has been completed, you sell your relinquished property. So as it sounds, it's the reverse of what a regular exchange is. Now, the process, of course, is a little bit different because now you don't have this 45-day timeline to identify because you've purchased the replacement. Now, Where this gets tricky is when you do a reverse exchange, as an exchange accommodator, we have to take title to the replacement property while you sell your relinquished property, because you can't hold title to two properties at the same time. So what we do is we take title, we act as the essentially quote unquote straw buyer, and then we lease the property back to you, the replacement, under a triple net lease agreement while you sell your relinquished property. And you have 180 days to close escrow then on the sale of your relinquished property. And then you've essentially completed the reverse exchange. And a lot of people ask about these because they think to themselves, well, that would be much better if I can purchase the replacement first, because then I don't have to worry about IDing a property within 45 days. And understandably so, but in addition to us having to take title, when we transfer the replacement property back to you, that results in duplicate transfer taxes. And in addition, it can be pretty tough to finance reverse exchanges because a lot of lenders don't like to lend on a reverse because they don't want to lend to somebody that's not going to be on title to the replacement property. So either you would need to purchase the replacement property with cash out of pocket, or you would engage a maybe hard money lender to loan you the money for the purchase, and they can be more expensive as well. So before you ever look into the reverse, it's important to keep in mind these costs, in addition to whether or not you can get financing for that type of transaction, because they are complex and they are costly.
Yeah, good synopsis, Matt, and really hit the nail on the head. In a reverse exchange, you buy first. You have 180 days to sell. If you sell within 180 days, that sale is tax deferred. Problem is, you don't have any money to buy the new property because you haven't sold anything, so you got to go to your savings account. The second problem is financing. It's really hard to get a lender to loan you the money on a reverse exchange because we have to take title to the property that's being bought. So traditional lenders don't like these. We've got a couple hard money lenders that we can refer to you. I think Vicky was asking about what lenders would loan on a reverse. So we've got a few hard money lenders that will loan, but I will tell you this, they are more expensive. So, the good thing is you're going to be able to pay them off as soon as your building sells. But for that period of time, you're going to pay, for that short period of time, you're going to pay 2, 3, 4 points. The rate's going to be higher. So you're going to budget, quite a bit for a reverse exchange. Our fee on a reverse exchange is $6,500. You've got additional escrow and title fees. You've got additional lender fees potentially. You've got duplicate transfer fees. So you're not going to walk away from a reverse exchange for any less than $10,000 to $15,000. All right. Here's my suggestion to you: don't do a reverse exchange. Well, what if I have to? Well, in the most, we do them. We've got probably 5 or 6 going on right now. But I always tell people, just don't do a reverse exchange. Here's what I'd rather you do. If you're worried about the time frame, things like that, just delay the close of escrow on your sale to buy yourself more time. All right. If you found a property and you absolutely have to buy it, well, put an offer in and ask for 30, 60, 90, 120 days to close. That'll give yourself more time to sell your property. All right. So there are workarounds, but we do reverse exchanges, right? People need to do them, so we do them. They just have to pay a little bit more to get those kind of deals done. All right. So, ladies and gentlemen, we are approaching, I think it's actually 1:59 right now. I like to start on time and end on time, so we're going to go ahead and end. I've got my company information on here. I don't know why I have Jason. I think he did our last presentation with us. He's not on the call today. I've got my buddy Matt on the call today, but we both can be reached at this toll-free number here. You got my email address on there, our website. I appreciate everybody who joined this call. Thank you for taking an hour out of your day to make yourself more educated about the 1031 exchange process. If you have questions, if you need to open up an exchange account, please, ladies and gentlemen, give us a call. We look forward to working with you on your next exchange. I did mention the pricing for reverse exchanges. I didn't mention the pricing for a regular exchange. It's really cheap. Okay, it's $750 when you sell and $200 when you buy. So if you do a regular exchange where you sell first and you buy, you're looking at under $1,000. And I'll tell you this, ladies and gentlemen, we routinely save clients hundreds of thousands of dollars. Nobody's better at this than us. We've been doing this a long time. We've got a tax attorney on staff, and it will be our pleasure to work with you. So hope to hear from everybody soon. Thank you all very much for a great webinar, lots of great questions, and a great crowd. Everybody have a great rest of your day. Take care.
Take care, guys.